Great afternoon, everyone. Thank you so much for joining. First and foremost, financial literacy is something that's unfortunately not taught in schools. Now, in order to manage our life, manage our lifestyle, and take care of the things that are important to us, we all know that financial management is vital to our survival. So, Financial Literacy 101 is a part one of a part four series that I will be having. My name is Sheree Henry. I am a financial consultant, and my goal is to help person manage and maximize their finances. Financial Literacy 101, we're really going to learn about our financial health and management. My name is Sheree Henry, and I'm really here just to guide you. All right. Now, we've already done the icebreaker, which is awesome. So as I said before, I know you guys saw the flyer, but here's what we'll cover today. The key components of financial literacy, the 50-25-25, which is the rule of money, and managing debt. Now, financial literacy, I have learned quite a bit regarding this after reading Psychology of Money and Rich Dad, Poor Dad. Has anyone ever heard of the book Rich Dad, Poor Dad or Psychology of Money? Anyone? No one? Well,
Yes,
you
I have.
guys, awesome. That's good to know. I hope you guys ready. I hope so. All right. Awesome, Akila. Now, I've come to the understanding that finance is taught like a science as opposed to a soft skill. So a lot of persons think that there's some rules and laws that govern finances when really it's based on behavior. So finance is guided by behavior. And what we've come to understand is that financial literacy is the understanding of concepts including savings, investment, and debt that leads to an overall sense of financial well-being and self-trust. So it's not how much you know at school, how much your grades are that helps you to manage your finances. It's really how you behave. How are you saving? How are you managing your debt? All right. Now, if you look to the right corner of this slide, you will see some key concepts that I took from Rich Dad, Poor Dad. And it's really the difference of how their mindset is. The poor dad believes that the rich should pay more in taxes, while the rich dad believes that taxes reward those who produce. And we can see this because business owners, they are able to manipulate, let me not use that word, they are really able to maximize on how little taxes they pay based on how much input they're putting out, creating businesses and having many employees. So they get the knowledge to know how to bypass certain things legally. My mother always says, we should not evade our taxes, we should avoid them. So there are legal ways to do that. Now, another thing that I looked into was the poor dad. The poor dad study hard so that he can find a good company to work for, while the rich dad study hard so that he can find a good company to buy. The poor dad says that I'm not rich because I have children, when the rich dad says I have to get rich because I have children. Now, the poor dad, if you realize, a lot of our family, we don't really sit down around the table and talk about money and business and finances. Well, a rich dad, he does do that over dinner. That's a common thing to discuss. The poor dad does not take risks, while the rich dad learns to manage risk, and that is very vital in managing our finances. Now, a poor dad believes that a house is the biggest asset you own, while the rich dad thinks that a house is the biggest liability you own. The poor dad pays his bills first, while the rich dad pays his bills last. The poor dad believes that he will never be rich, while the rich dad says that I'm a rich man and rich people don't do this. So what you've come to realize through all these pointers is that it is based on your behavior, your mindset. What are you thinking you're capable of, and what are you doing to get there? Now, what we've come to realize is that without financial literacy, or either shorten it and say FinLit, you have poor saving habits, you have poor spending habits, you have excessive credit card use or borrowing, and there you make a lot of bad investment decisions. With FinLit, you have proper budgeting and saving methods, you have proper money management, you use credit, but you only use it to build good credit or to gain assets. And you empower smart investment decisions. So there is a downside when you don't have financial literacy, and there is, of course, an upside when you do have financial literacy. Now we are going to get into the key components of financial literacy. There are 5 of them: earn, spend, save and invest, borrow, and protect. So the first one that we're going to get into is earn. Before you start saving, spending, and investing, you must understand your total income being earned. You should understand the difference between the gross and the net income. And you must note all deductions for all taxes and insurance if applicable. So when you're earning your money and you see on your payslip, this amount is going towards NIS, this amount is going towards NHT, don't just take your payslip's word for it. Go to the Ministry of go to the NIS office. I believe it's the Ministry of Social Security. Go there and check and ensure that your employer is paying over your deductions, because you don't want it to be a case where it is stated on your payslip, but yet it is not actually happening. All right. Now, the second principle, which is spend, we all have to understand that in order to know what we will spend, what we will save, and what we will invest, we must create a personal budget. Some people don't like budget, but budget is important. We can't just get the money, use it to do this and that, and we're not sure exactly where it is going. I'm sure you all agree. So we have to include all the needs, the wants, and savings on this list. We have to ensure that we include a buffer for any emergency or incidental situations. Your plans must be realistic. You can't have an unrealistic budget. If you're making 100,000, your budget can't be saying 114 for all the needs and the wants. You have to make it realistic. Now, one thing that we realize is that a budget helps you to manage your money instead of your money managing you. So track all your expenses. It means tracking your weekly expenses based on how you get paid, and then you mark it up a little and track your monthly expenses. That way you know exactly what you're budgeting for. All right. Now there are 2 types of expenses. There are fixed and there are variable. Fixed expenses really mean that the ones that really don't change. Say, for example, let's say maybe your insurance premium or bills are, I don't consider bills fixed. I would consider them variable because they change over time based on your usage. So maybe your grocery can be a fixed. Your bills can be variable. All right. Now, additional to spending, I know it can be hard. It can really be trying to control your spending. So one method that I've utilized is called the envelope system. What you do when you get your salary or your pay fortnightly, whenever it is, you partition the money. You get some envelopes and you say, okay, $5,000 towards internet, put that in the envelope, internet. Put $10,000 towards transportation for the month or for the fortnight, you put that in an envelope. So you separate your cash in envelope and tuck it away. If you have different bank accounts, however, you can categorize each of your bank accounts. So one bank account for expenses, one bank account for savings, one bank account for wants. So you don't dip into either of them. You have it geared towards exactly what you want it for. All right. Now, save and invest is the third component. Everyone understands the value of saving money, but it is not easy for some of us. So without clear financial objectives, to strive for, it can be challenging to spend less than you actually make. So your specific scenario will determine your financial objectives, but saving and investing should always include: 1, an emergency fund; 2, retirement planning; 3, saving for big purchases; 4, paying off personal debt; and 5, planning for insurance and investment. So you have to ensure that when you're saving and investing, you are limiting your trips to the ATM, because if we go to the ATM too much, we're going to end up spending more than we really want to spend. So that's why the envelope system, whether you're using actual envelopes or you're using different bank accounts, is very useful. You need to cut your spending on non-essential items. We as Jamaicans, when we get to pay, we always think about that little nice something there, what we can get for ourselves. But in the long run, that little money, you can direct it in better ways, saving and investing, in order for it to maximize and multiply. And that is the goal, to have financial security, right? What we should also do is set short and long-term goals. So set goals that you want to accomplish in a year to 3 years, which would be considered short. And then goals that are above 4 years, 4+ years, you can consider those long-term goals. Now, borrowing. A lot of us don't like to hear that word, but you can borrow money to acquire assets. So borrowing is not really a bad thing, as long as you know how to compare the loans and you know how to maintain a good credit score. The Jamaican banks have started to follow or utilize credit score method for quite some years now. And it's something that a lot of us didn't know was really going on. So if you can avoid borrowing, please do. But for most of us, in our experiences, getting a tertiary education, a lot of us have to borrow. If you want to get a home, we have to get a mortgage. And if you want to get a car, we have to get a car loan. So it is really easier said than done. So some of the things that we have to consider the initial fees, the interest fees, and the late fees. We have to evaluate these 3 key areas so that we choose a loan option that is manageable for us, right? Now, one example as it relates to like student loan or the credit union. Some persons, because everyone knows about the Student Loan Bureau, getting a tertiary education, we all go to the student loan. When in truth and in fact, if we had done our research to see what are these 3 key fees, which one is better, credit union offers some good rates, right? Which is way better than the Student Loan Bureau. Now, another key thing that we also have to consider is APR. APR is the annual percentage rate. This is key in comparing loans, or if you're going to take out a credit card, because it takes into account the interest rate and all the fees that you will be paying yearly. So it gives an accurate idea of it. All right. Now, the next thing that we have to look at is protecting our finances. We have to try our best to prevent fraud. So protecting your assets and your future when you are able to, in order to avoid risk in life. So, check your bank account, your investment or your insurance account, your retirement account on a regular basis. Keep it up to date. If your number change, you need to update your number, because if anything should go wrong, they will not be notifying the correct persons, right? Another thing, create a strong password. If you can have a 2-step verification, that is even better. Be skeptical of every email you receive, especially when it's in regards to anything that you didn't sign up for or any financial services. Because I'm not sure if you guys have heard of the situation where persons with NCB accounts, approximately, I believe it was 19 mil or 20 mil, something around that amount, people were scammed over the phone. They were told to click on a link or told to get in contact because their account was compromised, or whatever strategy they used, and they were able to scam these people. So you have to be aware of what sounds fishy. Anyone that calls you and they're asking for personal information, because you win something or they want to send you something, that's a no-go. So we have to protect ourselves against fraud. Now, another thing that we have to think about as it relates to protecting ourselves is buying insurance. We buy insurance for a car, but yet a lot of us don't buy insurance for ourselves. But insurance promotes positive saving habits by allowing you to invest in a financially stable future. So if you should fall ill this minute, you are no longer insurable. No one else can help you. So some things that we have to think about is, who are you trying to protect? Are you trying to protect yourself? Are you trying to protect your children? What is really important to you? These are some things that we have to think about and consider. If something should happen to you right now, where will your family live? Because a lot of us, we might not have children, but our parents depend on us, or there's someone that depends on us, right? If what would you do if something should happen? Now, another thing that we have to also consider is, how would you feel if you were able to do something and you didn't do anything? So we have to plan all around. If we're planning for our house, we have to plan for our car, we have to plan for our lives, our education, our children, everything around us. We must set up under that umbrella of protection. All right. Now, the second topic that we will be going into is the rule of money. The original rule states that 50, 30, 25, but I have slightly adjusted it because I believe that you should be saving more than what you're spending on your wants, right? So this rule states that 50% of your net income should go towards your needs, 25% towards your wants, and 25% towards your savings. But of course, this rule is not an all general rule. You have to adjust it based on your income, your needs, your wants, and exactly what you're saving for. Let's give an example. If someone is making 200,000 per month, they have no student loan debt, they have no car or car loans, they don't have a mortgage, they're just paying rent, they don't have any children, no dependents, they should be saving more than someone who has the same income of 200,000, but yet they have obligations, they have children, they have mortgage, they have car loan. So the difference between the two is that the former person, the one without obligations or dependents, they should be saving more, so they can bump up that 25% a bit more than someone who has obligations and has debts that they need to basically remove out of their finances. All right. So you have to adjust it based on what is best for you. Now, for some persons, as I said before, this rule may not apply based on your standard of living, your expenses, and your debt obligation. All right. Managing debt. This is the last topic that we will be handling today. And you have to know what you own. So just as how we make a note of every meal when we're trying to eat healthy, we make note of every debt you may have. So all the details, the balance, the interest, and the minimum payment required. Now, there is a method that you can utilize. How you can pay it down is the snowball method and the high interest rate method. Now, the snowball method is when you choose the smallest debt that you have and you pay it down. So you pay as much as you can. If you have other debt involved, you pay the minimum on those, but the smallest one, you try to get rid of that one as quickly as possible. Now, the high interest rate method, however, is really choosing the loan or the debt that you have with the highest interest rate, and you pay more than the minimum. You pay as much as possible as you can. If there are any other debts or loans that you have, then you pay the minimum on those. But the one with the highest interest rate method, you pay as much as you can to clear it off. I'll give you another example with the Student Loan Bureau. When you pay, if you have a student loan with the Student Loan Bureau, well, when you pay that debt per month, if you do it online, that debt is going toward that money that you pay is not going towards the entire figure. It's going towards the interest. what is best for you is, say, for example, you are paying $15,000 per month towards your student loan debt, and you have maybe 500,000 remaining to pay. If you are paying it online, it's going towards interest. If you go into SLB office and tell them, hey, put it on the principal, then they will put it towards the principal. What that means is when that 15,000 is going towards the principal, the interest that is being calculated off the principal is being reduced. But if you pay online and the 15,000 is going towards the interest, the same interest that is gathering from the principal is going to be higher. So I'm not sure if I've explained it clear enough. Putting the payment on your principal is better than putting it on your interest, because putting the payment towards your principal means that your interest is being lowered over time. If you're putting the payment on your interest only, the same interest that is able to increase from the principal is still happening. So you're technically paying more. Is that clear, everyone? Is that clear?
Yeah, man, clear. Yeah, man, clear as crystal.
Awesome, awesome. Now, controlling your debt. Set up regular automatic payments. So don't depend on yourself to send over the money. You can set it up automatic. So as soon as you get your salary in your account, it goes straight to where it needs to go. To pay debt faster, you have to cut some of your expenses from your budget, or you boost your income with something secondary. There's a lot of things on the side that you can do. Now, another thing is you borrow smart and think hard before you take the debt on. So you have to consider, is this a need? Is this going to increase my asset? If not, don't consider it. Now, are there any questions? Because we have reached the end of our session. I'm seeing where someone asked a question in the chat. Yes, is that the same for car loans? I'm assuming regarding the principal and the interest, yes. It's best to go into the bank and tell them, hey, put it on the principal. All right. Does anyone have any other questions?
Not really, but I am in debt now, so I guess I'm going to have to try the snowball method.
Okay, that's very good. Let me know how it goes. I have your email address.
Yeah.
All right. But before we go, yes, Akila, setting up setting up automatic payments is best, because we miss the money that we never see. Pretty much. All right. Before we go, we're gonna have a little exercise after, and I will be emailing you guys at the end of the session a recording of this live, and also I will be seeking feedback on what you've learned, what you think could have been better, so that we can move forward better for the next session. I hope you all had an informative session, and I hope to see you again for part 2 of Financial Literacy 101. You will see it advertised on Instagram, and you can also reach out to me if you have any questions or any concerns. I'm always here to help. All right. So thank you once again for all joining. Thank you, Jody, and I'm glad it was informative. Thank you. If there's any questions, you can also message me, all right, or call me on that number. So take care, everyone, and have a spectacular evening. My name is Sheree Henry, your financial consultant, helping you to manage and maximize your finances. Bye. Have a good one.